Welcome to a video that I like to call the deep dive video. Please don't let the name mislead you if this is the first time you're watching any videos that I post. This is a little bit different context. Every week I do a number of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video, and you're welcome to watch those. I post them on YouTube and Rumble. Well, after I get done doing all the different videos, I go through all of the daily charts and I look at them and I say, okay, I didn't really talk about that chart this week. I didn't talk about this one. Well, I only talked about that one once or twice. And I go through and I create this video using charts that sometimes I only show in this video, but other times they're charts that you might see from time to time in the daily videos that I do, just because looking at these charts may give us some insight as to what's happening in the market. This is being prepared for Monday, October 9th. The first chart, which is a chart that I only show in this video, this is the VIX, but you don't see the VIX on here because it's invisible. On top of the VIX is a 50-period exponential moving average, and that's what you do see. That's the blue line. We typically use static numbers with the VIX, 12 to the downside, 20 to the upside. Well, the VIX doesn't always stay within that nice little confined range. Sometimes it, for extended periods of time, will go above and set a higher range. Other times it will drop down and set a lower range. Then from about 2000 or 2020 or so, we went higher after the COVID plunge. And over on the right-hand side, we're coming down and we're wondering if we're setting a new longer-term range for the VIX. Even though the market's been under pressure lately, the VIX has been going back up. So we're seeing this turn up just slightly. We want to note, are we going to continue to go down and set a new range, or are we going to go back up and go back into the range that we've been in previously? Another chart that we look at is the VIX again, and then we take a 3-month average of the VIX, and then we make a ratio between the two. And this gives us a longer term look. Is the VIX having a tendency to go up or down? On top of this is another 50-period exponential moving average. And when it's going up, that means the VIX is tending to trend more or less higher. As we were going up in the market, we were really coming down. Once we got into the latter part of July and into August and started to really hit some problems in September, we've been seeing this red line starting to go back up. So this gives us a longer term indication. Is fear increasing or decreasing? Because these lines tend to move in the opposite direction of the market. Then we have another study of the VIX, because sometimes the VIX itself doesn't tell us all that much. So I have a number of different studies that I look at. This study is a correlation between the VIX and the S&P 500. When we spike up with this correlation, that's the middle area. Typically, something will happen with the market at that time. We have the S&P down below. Right now, we're getting a very low reading from this, and we're getting some rather useful insight just from the VIX itself. So this chart hasn't been useful lately. We also do another study that's kind of like the VIX. The VIX itself looks at the money options, where the skew index, which is what you see here in the middle, that looks at out of the money options to get some additional insight. And when we get up into this red area and top out and start to come down, sometimes that marks a top, sometimes that marks a bottom, sometimes that marks a continuation of what's happening at the time. And we just sometimes look at this to say, okay, the market is expecting something big to happen. It might be a turn, it might be a confirmation of what we're already seeing, or we might not get much from it at all. So we don't use this chart in isolation. Then we have another study. The MOVE index is on top, and this measures the volatility of bonds. The VIX measures the volatility of stocks. The green line down here is the spread between the two to kind of give us an idea. Well, as we were really coming down, now we've been starting to go back up. The red line is the S&P 500, just to get some context there. And what I really follow is on the bottom to look at the correlation between the VIX and the MOVE index. And they're having a pretty strong tendency right now to go in the same direction. Then this is a daily chart of the equity put call ratio. As I explain every week, this is the last chart to be updated. And a lot of times when I'm preparing to do the video each day, this chart still hasn't updated yet. But some other charts that we do studies on, they do update. Try to figure that one out. Well, in Friday's session, we had a pretty solid update. So the equity put call ratio went down. This is another indicator that tends to go in the opposite direction of the market. When this is really going up, that means more folks are hedging using puts. When this is coming down, because buying those puts bites into your overall returns. And when the market's going up, they have a tendency not to buy those puts because they see that as wasted money. Then we look at a longer term view of this same chart, the 5-period simple moving average of the equity put call ratio. I've been showing a shorter term version of this chart because we're really watching this. Longer term, we can see when we spike up and start to come down, a lot of times that marks a bottom in the market. Sometimes when we get to a really low reading, that can mark a stall. Usually not very good at determining a top in the market. Well, we're getting an extreme reading over here. When we go above 0.8, and we're waiting for this to top out and start to come back down. And sometimes that can mark a bottom in the market. We're also looking at another fear gauge. I have a number of fear gauges that I follow. This is one that I show kind of off and on from time to time, where it's been going up overall as we've been going down, but it hasn't been moving all that much lately. Now, part of the problem with this is we have this huge skew going back to the COVID plunge when this fear gauge really went up and then started to come back down as we were climbing up from that. So that's kind of making it a little hard to read some of the numbers over, or the figures over on the right-hand side. Then we look at a ratio between the VIX and the MOVE index, and we're coming back down to the moving average. As the market and bonds were under a lot of pressure, this was really starting to go up. Now it's coming back down, but the red line, which is another moving average, it's continuing to go up, showing the volatility is still increasing longer term based on this ratio. Then just to keep an eye on where are we since we set the all-time high, which seems like ancient history now. That was at the beginning of 2022, way over here on the left. Way over here on the right is where we closed in Friday's session, and we're down 10.59% from the all-time high. Some technical alerts. These are put out by stockcharts.com. And the last I checked, you don't have to be a member. I always log in and I'm a member there, so I'm not quite sure if they've changed that or not. But these just trigger objective, meaning they're mechanical alerts when something either positive or negative happens, not only in the S&P, but for the Dow, the NASDAQ 100. And it also looks at different sectors in the markets and measures them against different technical indicators. To give you an idea, these are the technical alerts that were triggered this past week. And it'd take me forever to read through this. I'm just going to refer to it. But when we're really going down like we were earlier in the week, you notice how most of these are red. And then we started to bounce up in Friday's session, and most of these are blue or green, depending on how you see this. So we can get kind of a feel for, are the alerts that are being triggered more positive or negative? And then we can go and actually look at the alerts themselves to see if they're telling us anything outside of the S&P. Then what we do is we look at 5 different indexes. I look at many, many indexes, but the ones that I show here are the S&P 500, which is pretty much the focal point of everything that I do. But we also follow the Dow, the NASDAQ, the mid caps, and the small caps. So 5 indexes. And then stockcharts.com has this tool that rates them on a scale of 0 being the lowest and 100 being the highest. And how are they looking based on technical analysis indicators? The higher the score, the better looking the chart. And coming in again at first place, which has been in first place for a long, long time now, are the QQQs, which is the NASDAQ 100. Now, that's positive because we did tick up a little bit this past week and we're getting close to 100. But you can see the historical values, if they've changed over the last few months, this has been flatlining as the market's been under a lot of pressure. So in that regard, it hasn't really been helping us. On the positive side, you can say, well, look, we had this pretty significant downturn with the NASDAQ 100. And to this point anyway, if we continue to fall, we are not seeing a lot of technical damage being done to the NASDAQ 100. So there's a positive side and a negative side that you can take for this. In second place is the S&P 500, represented by the SPY, or the Spiders ETF, and it bounced up a little bit, giving us a score of 81.4. In third place are the Diamonds, which is the ETF for the Dow Jones Industrial Average, and it's coming up just a little bit over the last few days, giving us a score of 56.3. In third place are the mid caps. They've been under a lot of pressure lately, but as I've been pointing out in the daily videos, we're seeing some pretty good strength, or at least maintenance of strength, when we compare mid-cap growth to mid-cap value. And we're also seeing that in the small caps too. So even though the overall index has been under pressure, giving us a score of 39.3, it's holding up more internally right now, which could be longer term positive. Then in last place is the IWM, which is the Russell 2000 ETF for small caps. I used to use the SLY, but they changed that all around and it really doesn't give me a score anymore. So I switched over to this other ETF and they're in last place. The small caps have been under a lot of pressure. In a good environment, we want to see the small caps and the mid caps doing well. But when you compare growth to value for small caps, it's still holding up. But you have to see those charts when I do the daily videos. But it comes in last place right now at 28.2. Then we have some short-term charts to look at. This is a 20-period double and triple exponential moving average. This is calculated different than your regular moving averages. And we've been coming down with both the blue line and the green line, so we're negative. But in Friday's session, we did shoot up above both of these lines. That is neither positive or negative in and of itself. But if we can get some traction and start to go up, we will eventually see these the lines here, the blue one and the green one, turn back up. And that would help to turn things back more positive. Then we also have a regular 20-period moving average, but I do this two ways. There's a simple moving average. That's what most people tend to use. And there's an exponential moving average where it's more weighted to the current price, and it tends to move a little bit faster. And even though we've been bouncing back up a little bit, we've been chopping sideways, we've been going down overall, we're still underneath both of these moving averages. It would turn more positive if we could climb above both of these lines and then close above these lines as well. Some intermediate term charts. This is the same principle where we have a double and triple exponential moving average based on 50 periods. So it's a more intermediate term. And the red line is going down below the blue line. So that's more negative. We did come back up and close above the red line here. It would be more positive if we could stay above this and see these lines turn and eventually see the red line crossing back above the blue line. That would turn things more positive. Then here's a regular 50-period moving average, both a simple and exponential. And we're bouncing back up now, but we're still well below these lines. And it's going to take us quite a bit to get up to these levels. Now, if we do start to go back up, these may act as overhead resistance. And then we also look at a 100-period moving average, and we're below that as well. We actually came down to the 200-day exponential moving average. That seems to have been critical this past week, and I've been showing that in the daily videos. But if we come back up, this may provide some overhead resistance. And if we continue to go up and close above this, the red line would eventually cross back above the green line. Here's the Copic curve, which I usually only use this for buy signals. That's when the black line crosses above the red line. But you could also call this a sell signal when it drops down below the red line. Well, it's still negative for right now. It's turning back up. And if we see another day or two of some positive action in the market, this could actually cross over and give us a buy signal. Unbalanced volume, which pretty much takes all of the up volume if it's an up day or all of the down volume if it's a down day, and then measures it on a running total. This was one of the very first technical indicators to be developed decades ago. Well, right now, we're below a declining moving average. So the tendency has been for things to be more negative. If we can get back above the red line and see the red line turn back up, that would turn things more positive. Standard deviation, it's like looking at the average price over the last 10 periods. That's what I have it set to on this chart. And we were really moving there for a while. Now, this doesn't measure direction. This just tries to measure movement. And you have to look at other charts to see what direction it's actually going. And we spiked up with the standard deviation, and now we're coming back down as we've been chopping more or less sideways recently. Then the Pring bottom fisher, which is kind of as its name sounds, when this gets to a really low reading and then comes back and crosses above the red line, that's can be very helpful in determining when the market is actually bottomed out. We're not there yet, even though we may be seeing some improvement, or we may end up falling below the 200-day simple moving average. We don't know that yet. But if this was to come back up and cross above, that would generate a buy signal. This is the Sean trend meter, and we've been neutral in this kind of sickly looking yellow tan area where it almost came down to an extreme negative reading before it started to see a bit of a bounce. When it's in this area, it's more or less neutral. Look at the Connors RSI, which we look at just like we do a regular RSI. We use it to give us extreme positive or negative readings, and then we can look at the direction. But this is pretty spastic. It moves pretty quick. We don't get extreme readings all that often. We had one late in September, and since then we haven't had another one. When we're above the dash line and going up, that's more positive. When we're below the dash line and declining, that's more negative. We also look at the mass index, which did generate a signal back at the latter part of August. And that's when we hit the blue line. And then when we cross down below the red line, that's the signal. And whatever the market's doing at that time, this indicator is anticipating a change in trend. Well, we started to generate this signal as we were coming down, but then as we were bouncing back up in August, that's when the signal was actually generated. And it's like, okay, is this a positive signal or a negative signal? And as we've been going down lately, this hasn't been moving all that much. It ticked up a little bit in Friday's session, but this pretty much became an irrelevant signal. So we use other charts to help us look at what's going on in the market. This is the percent B indicator. Sometimes when the market really gets moving up or down, it will close outside of its upper or lower Bollinger Band, but it doesn't stay there for very long. When that happens, we get either a positive or negative reading with the percent B indicator, and that can give us an extreme reading of some kind. It is negative now, but it is showing some improvement. It's negative because we're below this dashed line, but the fact that it's going a little bit higher is showing some improvement. We also look at the CMB Composite Index, which is supposed to be a standalone trading system. I'm not sure if it's short-term or intermediate term. I don't use this that way. I use this black line here like you would an oscillator to get an extreme positive or negative reading. We had one back in September, and then since that time, we've just been going higher with this overall indicator. Then this is the Ichimoku cloud, which is really just a series of moving averages that are shifted forward, but these can act as support and resistance. This is heavily used in the Forex market or foreign exchange market. And a lot of people really rely on these. I look at them, but I don't make decisions based on them. When we were coming down, we went back into the green cloud, and this had been providing some kind of support. Well, then we were able to, or actually we ended up breaking down below this, and we'll have to see if we do start to go back up, will this now provide overhead resistance? We look at the S&P 100, which are the biggest stocks in the S&P 500, and they're pretty much going in tandem with each other now. But earlier on, back in the spring, we were seeing a divergence here where the S&P 100 was making higher highs, but the S&P 500 was not. And that's what we look for here. And we're really not seeing anything all that strange. This is a point and figure chart, which does not take time into account. It only measures price movement, and you can set up, okay, how much does price have to move before an X, if we're going up, or an O is being drawn. And then there are different patterns that are generated on here. Well, this past week, we didn't see any X's or O's drawn on this chart. And the last signal that was generated was on September 26th, where we had a double bottom breakdown. Sounds kind of like a weird dance. Looking at some long-term charts, this is an anchored moving average going back to the all-time high on the S&P 500. And even though we've been declining, we're still well above this line, so I haven't been showing this chart. Then we want to know how far above or below are we from the 200-day simple moving average. We came down close, but not quite there. We're still wondering, are we going to continue to fall and actually test that 200-day simple moving average? We really haven't done that yet. We tested the 200-day exponential moving average, but not the simple moving average. And the simple moving average is what most folks rely on. But for right now, we're still above that 200-day simple moving average. We also have a long-term rainbow chart. Now, I've been showing the short and intermediate term charts in the daily videos. The long-term chart measures from 50 periods up to 250 periods, and we're coming down into the middle part of the rainbow, where we're rolling over a little bit with the shorter term moving averages. If we can start to go back up, we would see these lines turn and smooth out again. If we really start to fall, eventually we'll see these lines begin to all roll over and turn things more negative. Then we look at a weekly chart on the top of the S&P 500, and then a weekly chart of the German DAX. That's their main index in Germany. And then at the bottom, we say, okay, are they going in the same direction or opposite directions? What's happening? Well, right now it's more or less neutral. They're having a slight tendency to go in the same direction. When it gets up to a really high level, that means they're going in the same direction. When it gets down to this blue, down to the red area, that means it's more neutral. Then here's a longer term moving average study. I have a 50-period moving average study on top. That's really just for reference. What I follow on this chart is the 150 and 200-day moving averages. And as we've been showing a little bit of recovery over the last few trading days, this has been turning up slightly, but we're still negative because we're below the midpoint with the 150 as well as the 200. Some support and resistance lines. I've been using a lot of these charts, but this is the chart that I talk about in every video, but I only show it in this video unless we really start to fall. This is the long-term trend line that I keep talking about. And what I did to create this chart is I drew a trend line from the June 2022 low down to the October 2022 low. And there's the blue line here. And then I went up on top and I drew a parallel line going from the all-time high and just extended that down. And earlier on in the spring, when we came up to this level, yeah, it was providing some resistance, but eventually we were able to break through that. And we're still well above it for right now. If we really start to fall and I extend this line down and we get close to that, that's when I will be showing this chart again. This is another chart called a quadrant chart, where I go from the COVID low to the all-time high, and we just break up this whole rise into 25% chunks. Now, you may not think that that's all that important, but look at what we were hitting earlier on in 2023. This was providing some significant overhead resistance, and then we were finally able to break through that. Now, we're still a ways away from that, but if we start to come down, I'll extend this line over, and this may end up providing support, because what had once been resistance, once we break through it, if we come back down, now that tends to become support. Then this is a 20-period simple moving average of the open, high, low, close. I actually developed this decades ago and used it for another trading strategy that I implement. And then I just looked at this chart going, sometimes we can get some useful things from this. Initially, we can see, okay, the trend is clearly down. We have all of these lines going downward. Well, sometimes when we're going down and then we see a bounce in the opposite direction, one of these lines may act as overhead resistance. When we were going up and then saw a bit of a pullback, sometimes these lines can act as support. Right now, we're far away from the lines and the lines are currently declining, or really declining. And so I haven't been showing this chart. Some broad market charts that we look at. This is the Vixen, and I don't use the bar chart on top because of all this erroneous data. I mainly look at the line chart, and I really don't show this in the daily videos. The VIX that I follow is for the S&P 500. The Vixen follows the NASDAQ 100. And we're just showing that fear has been increasing overall, even though we saw it down in Friday's session with the nice up move that we saw with the NASDAQ 100. This is another study that sometimes I show a lot, but lately I haven't really been showing it. The top part is the S&P, and then we have an equal weight discretionary ETF. Then down below, and that represents more growth. Then down below, we have the Staples equal weight ETF, and that's more value. And we can see that Staples have just been really under pressure. And then at the bottom, we take a ratio between the two, and it's showing that discretionary is outperforming Staples. And even though Staples have been really under pressure, we're seeing discretionary under pressure, even though as a sector, it's been performing well in 2023. But the ratio down below, it's holding up for right now, but it's not really showing us any strength. Then we look at a weekly chart of the NASDAQ 100, and then we have another moving average, going back to the all-time high. And this is an anchored moving average. We're still well above this, even though we've been under pressure lately, so I haven't been showing this chart. We look at the bank ETF back in March. This thing just cratered, and it's pretty much been going sideways. We saw a little bit of hope throughout the summer, but kind of gave that back as we entered into the fall. But this is still in an overall downtrend. Then we look at the regional banking ETF and compare it with the financial sector, and it shows that the banks are really underperforming. Then we look at a ratio between the QQQs, which is the NASDAQ 100, and the diamonds, which is the Dow. And I mainly look at the bottom here for the correlation, and it shows that they're really not correlated right now. If anything, they're getting kind of close to going in opposite directions of each other, as we're seeing more strength in the Qs when we compare that to the Dow Jones Industrial Average. Then this is a chart that I mention all the time, but I don't show the chart because what I'm pointing out is this cumulative new highs, new lows for the NASDAQ. We started declining in about 2021 when we hit the top, and we've been going down ever since. And it doesn't seem to really matter right now because we've been seeing the NASDAQ doing quite well, but this ratio, actually, this is not a ratio, this is just a measurement, continues to decline. And I'm wondering, is this going to kick in and mean something at some point? Well, up to this point, it really hasn't. And then down below, to get a little more shorter term perspective, we just subtract the new lows from the new highs, and that gives us a raw score. When we're under zero and declining, that's negative. When we're above zero and advancing, that's positive. Some rate of change charts. This is based on 250 periods. We look at where are things right now, and then where were they 250 periods ago, and that's what is drawn here on the chart. And it shows that we were going up nicely, but now we've been starting to come back down. This is a longer term look at that same chart to give us some kind of extreme negative or positive readings. We're above zero, so that's positive, but we're not seeing an awful lot of strength in this chart currently. Keeping an eye on some different bonds. We have the S&P, which is in red on the top. And then we have the TLT, which is the long-term bond ETF. That's in blue. And you see how bonds have just been falling off a cliff? Well, stocks have been under pressure too. So we look at a longer-term relationship based on 50 periods. And when this is really giving us a high reading, that means stocks and bonds are going in the same direction longer term. Then we also look at a 10-period correlation. That's more shorter term, where they had been going in the same direction, but now we're seeing that trail off, especially as we're seeing potentially some strength in stocks. We're still seeing an awful lot of weakness with bonds. Then on the bottom is just different versions of calculating the spread between the S&P and the TLT ETF. How's that for acronyms? Then we look at 3 to 7 year bonds and compare them to stocks. When this is going down, that means that bonds are underperforming. They were bouncing back a little bit, and stocks were under pressure as well. But in the longer term, stocks continue to outperform bonds. Then this looks at value to growth. This is the reverse of a lot of the ratios that we look at. And what's resultant here is the black line where value is really under some pressure. And then just to make it a little more interesting, we plot a red line here, which is the 10-year yield. And they're having a slight tendency to go in the same direction after they had been neutral for quite a while. But if you look at the chart, it's like, huh? I mean, this line's going up and this line's going down. How could they be going in the same general direction? So I'm not really sure if this is a helpful study or not. I still look at it and I try to get some insight from it, but I'm not sure it's telling us all that much. Then we look at a ratio between the Qs, which is the NASDAQ 100, and the TLT bonds. Now, this is rather critical because a lot of tech companies, they want to do research and development, and they have to borrow money to be able to do that. And if interest rates are higher, that's going to bite into their earnings. And we look at the correlation where bonds have been under pressure lately, going down. And for the most part, the NASDAQ 100 has been under pressure. And so the correlation between the two is fairly strong right now. And then we look, and I'm not sure if this chart's really helping us all that much either. It showed up in an Isabel Net blog chart one day, and I thought, okay, I'll recreate this chart and see if it gives us any insight. The blue area is the S&P 500 equal weight index, and then down below we have the MOVE index, which again measures the volatility of bonds. And then we flip that upside down and then look at the correlation between the two, and I'm not sure, okay, yeah, they're kind of going in the same overall direction with each other. But is this really giving us any insight that we don't get in other places? Then we look, and I mentioned this in every video, at the 3-month yield. And we go back to the recent high. Actually, it was quite a while ago now. It set a high back in 2007. And then this was the cratering that we saw as we were going into the great financial crisis. We're going above that level now, and we're still continuing to go up. What we're watching for here is to see if this rolls over and comes back down. And is the same kind of thing going to happen like happened in 2007? Or is this just going to chop its merry way higher and not really give us a signal? We don't know that yet. So we're just keeping an eye on this. Then I have a number of things that are called possible positive scenarios. 2022 was a very difficult year. And so I broke out a lot of charts that we can use to help us know if we're actually reaching a bottom. when we're in a solid uptrend, these charts aren't as helpful. Some of these studies can be useful to let us know where we're at in a greater context. But one of the charts that we look at is we go through the Amex, the NASDAQ, and the NYSE. We take a 5-period moving average of their highs minus their lows. And if they're above zero and advancing, that's more positive. If they're below zero and declining, that's negative. Currently, we're negative here, but we can see that through other charts that we're looking at. Then we look at the 200-day simple moving average of those stocks that make up the S&P 500. We can use this like an oscillator longer term when we get an extreme positive or negative reading. Well, we're just about at the midpoint now. When we're below 50 and declining, that's more negative, but we are bouncing up after getting a lot lower reading earlier in the week. Then we look at a 50-period moving average study, the S&P. This did generate a signal not many days ago where we were almost down here to an extreme negative reading, and now we're starting to bounce back up. This could be positive for the S&P, but we're not really seeing any signals yet for the mid caps, even though this has been declining, and we're not seeing this for the small caps. We want to get down to this red line for this to generate a signal. Then we look at the 2-year Treasury yield, and sometimes when that tops out and starts to come back down, that will give short to intermediate term support to the S&P. Well, the only problem is this keeps going up, so it hasn't been generating a signal or much of one lately, so I haven't been showing this chart. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. If you just watch this video, you're probably going to lose some context of other things that I also analyze. And I hope you find that this video has been useful in addition to the other videos that I post. Have a great weekend, and I will talk to you in the next video.